Good morning. This is Larry McMillan with a market update on Monday, November 23rd, before the market opens. So this is Thanksgiving week, and that kicks off a bullish period for the stock market, beginning with the end of trading on Wednesday through the second trading day of the new year. The market generally advances, and in addition, small caps outperform big caps. Now, it doesn't happen every year. 2018 was, a very negative example. However, even in 2018, there was a pretty strong rally the week after Thanksgiving. Then things fell apart after that. Meanwhile, if we just look at the S&P chart, it's had a little trouble continuing to proceed higher the last 2 weeks. 2 weeks ago today, it spiked up very high on the Pfizer news, and that's 36.44, and then last week it got up to like 36.28. So those are both minor resistance levels, but we have fallen back below the old highs at 35.88, and that could lead to problems. If the S&P closes below 3,500, in my opinion, that would put us back in the old trading range and raise the specter of having to retest 3,200. So the bulls need to defend that 3,500 level. Equity-only put-call ratios are on sell signals according to the computer analysis that we run on them. However, if you look at the charts, they're actually beginning to slip a little. There was a lot of call buying again last week. 5 more days of the equity-only put-call ratio being less than 50. If you read our article a couple of weeks ago, you know that we're already in a record year for those kind of readings. And the longer term implications are bearish, though, because if that many people are buying calls, they're not all going to be right. Anyway, I'm not interpreting these put call ratios as being on sell signals right this minute until the ratios begin to rise again. That's despite what the computer analysis says. Breadth has been the most positive area of this market for really the whole month of November. Both breadth oscillators are on buy signals, and they're in overbought territory, which is fine. The cumulative breadth is making new all-time highs, and cumulative volume breadth, which we call CVB, is also making new all-time highs, and that's bullish for the market. New highs are dominating new lows, or I should say, new lows are practically non-existent. We've had, I believe, 8 trading days in a row where new lows on the New York Stock Exchange have been less than 10, single digits. One day there was only 1. VIX is pretty positive too. The VIX spike peak buy signal of late October is still in effect through the end of November, and VIX is remaining below its 200-day moving average. That 200-day moving average is still rising, which is a minor negative, and it will be continuing to rise for another couple of weeks, but at least. But that's right now, it's not affecting the market. And finally, the construct of volatility derivatives is modestly bullish too. The term structure isn't quite as upward sloping as we'd like to see it. It just slopes upward in the front end and then is flat after that. So all in all, our indicators are bullish. So are we. By that, we're not going to go against our indicators. And if we close below 3,500, that would change things. Meanwhile, there is this positive seasonal beginning at the close on Wednesday of this week. So we had a great Saturday webinar. It's available as a recording right now if you're interested in intermarket trading. Also, we discussed the market in general. And I would also invite you to take a look at our newsletters on our website. We are running some specials, and they've been performing very well. So thanks for listening, and have a great week trading.